Today, the housing debt trap is sprung on older Australians. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and problem news with a distinctively Australian flavour. More and more older Australians are finding it increasingly difficult to pay off their mortgage debt before they retire, and this is a big deal. And this receives significant coverage in the media today and on the ABC, and also in The Conversation. Outright home ownership has long been regarded as a supporting pillar of Australian retirement income policies, and a report released by the Australian Housing and Urban Research Institute, AHURI, raises concerns that rising mortgage debt and falling home ownership rates in later life are undermining the role of home ownership in supporting retirees' financial well-being. And the report said that achieving outright home ownership is similar to the accumulation of pension income entitlements that come on stream in later life. This is because the outright owner does not have to meet rents. That reduces the need for a large income stream to pay for shelter, as well as the chances of low-income older Australians falling into poverty. Now, according to the data from the Australian Bureau of Statistics Survey of Income and Housing, home ownership rates among Australians aged 55 to 64 years dropped from 86% to 81% between 2001 and 2016. And we're also seeing a major shift in older Australians' readiness to shoulder mortgage debt in later life. Mortgage burdens have spiked in the 55 to 64 year age groups. In 2001, roughly 80% were mortgage-free. 15 years later, that's plummeted to only 56%. Indebtedness is even growing among owners aged 65 and over. In 2001, nearly 96% were mortgage-free, but by 2016, this proportion had fallen below 90%. These trends are expected to continue. That means as the population ages, a growing number of older Australians will still be paying off mortgages or trying to meet rents from fixed incomes. Now, just before I talk in more detail about some of the broader implications, it's worth looking at some of the data. So this data is firstly from our own core market model, and it shows the relative distribution of total mortgage debt across the various age cohorts for both investment properties and owner-occupied property across Australia. And what's interesting about this is that you can see the very significant distribution in the 50-year-old and above group. So the point to make about this chart is that over time we've seen a migration to those in the older cohorts having a greater proportion of debt, and also, of course, the smaller number of people who are buying in their 20s and even 30s now. So this whole chart is shifting to the right, which then, of course, brings into question what happens into retirement. Now, the next chart is actually from the AHURI report. And this shows us the incidence of mortgage indebtedness as a percentage, which is the blue bar, over time, and also the level of mortgage debt. And you can see that back in 1987, we were below 15% of homeowners over 55 years with a mortgage. And that has been growing so that in 2008 it had got above 20%, and the amount of mortgage debt also was increasing on average. You can see that through the yellow line. And it has continued above 25% in 2012 and is now close to 27-28% in 2015, with an average mortgage debt of around $180,000. And we can also look at the relative distribution of income share to home value. So essentially back in 1987, the average share of income going on the property was under 15%. And that rose through the next few years. In 1997, it had come well above 30%. That was because interest rates were higher and the size of mortgages were increasing. And you can see there that home values have been growing. And in fact, the relative share of income going to service the mortgage has fallen. And the home value on average is above $700,000, and the average share of income is below 20%. This doesn't tell us the full story. We need to look at the ratio of debt to income. So this is money coming in versus the debt going out. Back in 1987, the debt to income ratio was around 70%. And it rose through the 1990s, 1997 to 2003. And you can see there that the line is the average disposable income. So read that across to the right. And you can see that the disposable income has been rising. Not very fast, but a little. And then essentially there's been almost no growth in disposable income since 2008. But the ratio of debt to income has continued to rise. So for this particular group of households above 55, the debt to income ratio on average now is above 200%. And that really highlights the pressure that many households are under. And they expect the number of outright owners aged 55 to 64% to plunge by 42%, from more than 1.2 million to 708,000. The number of 65 plus outright owners is predicted to rise by 41%, but this lags behind the 52% population growth in this age group. On the other hand, the number of older mortgagors and private renters are projected to soar. Among 55 to 64-year-olds, mortgage numbers jump from just under 1 million to over 1.6 million, a 71% increase, and the number of private renters rises by 54% from 369,000 to 567,000. Beyond what was the age pension threshold of 65 years, mortgagors and private renters are expected to roughly double in number. The combined impact of these changes in tenure and demographics is expected to increase Commonwealth Rent Assistance, the CRA, eligibility among seniors. On its own, demographic change is forecast to lift the number of CRA recipients and the real cost of providing CRA by around 35%. Add the projected increase in private rental share of the housing stock, and the number of CRA recipients is estimated to rise by 60%, from 414,000 to 664,000 between 2016 and 2031. The real cost of the federal budget of rent assistance payments for older Australians is forecast to blow out from $972 million to $1.5 billion each year. And we can also expect to see public housing waiting lists grow if these tenure changes and demographics eventuate. Their combined impact through to 2031 is expected to swell the number of older pensions eligible for public housing from 247,000 to 441,000. That's a 79% increase. And on an income-only basis, they estimate 1.25 million seniors were in poverty in 2016. On taking their housing costs into account, that number falls to about 802,000. But the role of home ownership in preventing poverty is challenged if their projected declines in home ownership rates and increases in debt eventuate. The demand for public housing will grow. If all else remains unchanged in the housing system and economy, seniors on public housing waiting lists will increase by over 75%. That's more than twice the 35% increase in the population of seniors between 2016 and 2031. As the number of senior private rental tenants grows, governments will need to reform tenancy regulations in ways that enable housing retrofits to meet mobility needs and allow for ageing in place. Tenure insecurity in the rental sector could hinder planning for age support services. We may also see a more fundamental transformation of Australia's housing system and lifestyles in old age. High real house price growth relative to incomes remains a barrier to first home ownership despite low interest rates. Furthermore, the mandatory superannuation guarantee likely displaces some savings in other assets, including housing. There is therefore a growing prospect of delayed entry into home ownership and of people carrying more debt into later life. Longer working lives and the use of superannuation benefits to pay down mortgages both look increasingly likely. And the point I want to make is that taking debt into old age, which many more are now doing, is going to create massive pressures on them and on society more generally. And yet we're in the situation where the government is now stimulating once again the housing sector through easier borrowing requirements. And remember, our household debt is higher than it's ever been. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.